Thank you guys for joining. I'm really happy to be here. It's exciting. So for those of you who don't know, Renaud, or his company Upgrade, they've made a lot of waves since Renaud left Lending Club in 2016. One of the things that is of really pops out to me is just the growth. For a couple years now, you've had the fastest growing, one of the fastest growing credit cards in the country by balances, according to the Nielsen report. Seems like you're really one of the fintechs taking advantage of the fact that credit card interest is so high in this country. People get mired in debt, with these rapacious interest rates, and here you are offering an alternative that you think is better. So, first question for you, how did you do it? How did you create something that has taken off the way it has?
Yeah, so a lot of our product strategy really starts from the recognition that credit cards are fundamentally bad consumer products. I think there are three fundamental issues with credit cards. First, they're typically very high rates, right? It was in the sort of 16, 17% interest rates with all the rate hikes recently. Now it's in the low 20s. Second, there are a lot of fees attached to it. So the CFPB is coming down pretty hard on junk fees on credit cards, but it's still there for the most part. But probably the third and worst feature of credit cards is the monthly minimum payment. It's the fact that credit cards are fundamentally designed to keep people in debt as long as possible. And if you only make that monthly minimum payment, you're kicking the can down the road and you're not really making these payments, making a small payment, and you're not amortizing the balance. You're not getting out of debt. And so what we did with Upgrade Card was really sort of taking the opposite of all that, with no fees.
This is the flagship product, right? The Upgrade Card.
Yeah, that's really our flagship product. So we went out with no fees, with low rates, funded mostly by credit unions. And more importantly, we made a card that is really sort of helping consumers get out of debt. So they use the card. It's okay to use credit when you have a large, big, exceptional expense, a large purchase, but then you want to pay it back every month with straight line amortization, payment of principal and interest, like an installment loan. So it's really an installment card. And I think that sort of tag of a more responsible credit card was a bit of a leap of faith, right? Be more responsible is not a great marketing slogan, but it turned out that there was a lot of demand for it. A lot of people were wary of credit card debts, having been in credit card debt or having had this experience with their friends and colleagues. And so the idea of a responsible and so more affordable credit card really took off.
So I'm curious, Renaud, what's your APR range versus kind of the prevailing, what you see in the credit card industry otherwise?
Yeah, so I mean, we're designed to be sort of 3 to 4%, so 300 to 400 basis points lower rates than traditional cards. And the way we achieve that is really by sort of operating at a low cost, right, in a fully online, highly automated digital way. And also by really using our partners, mostly credit unions, that have a lower cost of capital. They're typically sort of non-for-profit. They have sort of lower return hurdles than many other sources of capital.
We're going to get to this. This is the network of 200 banks that that you partner with. That's kind of the key part of the whole equation here. Okay, so you've got to recap, there's the Upgrade Card, right? That's the flagship. You got a high interest savings, which we'll talk about. That's interesting. Personal credit line, debit card. Sounds like a bank to me. I mean, can you talk to me about, what the end state's going to look like for you guys, how applicable that is to the larger competitive set, and thirdly, whether you need to own a bank for that, ultimately. Not today, but in the future.
Right. Yeah, so I mean, I think in terms of product strategy, we always go back to the customer and what customers want. I think what they want at the end of the day is something that's going to simplify their life, like simplify their approach to money, and also just like get more value from their banking relationship. So if we can make products and experiences that are simple and deliver value, I think we would continue to gain market share. So, for example, what we did recently was trying to combine two products that consumers have been holding in their wallet for a long time, so it's a debit card and a credit card. And so we created Upgrade One Card, which is really, I think, the only sort of combo, sort of credit and debit. The only card that you can use for what we call pay now and pay later. And it really sort of helps you sort of simplify your life. You don't need to carry 2 credit cards in your wallet or on your phone. You have a single card, and you can decide for any set of expenses if it's going to be a pay now expense. It's going to be debited from your bank account, so similar to a debit transaction, or a sort of credit expense. If it's a larger exceptional expense, you're going to spread that.
There's
over
a prompt,
several months.
and so you have a choice, or how automated?
Yeah, you can go to the app, and for each transaction, you can say pay now or pay later, or you can set some rules and say, hey, for everyday transactions, let's say less than $100, it's going to be a pay now, and for more than $100 or $200, I'm going to pay later over 1, 2, 3 years. So you can choose how quickly you pay it down. So that kind of product really makes it simple for consumers. At the same time, the way the product is built, it's really a credit card at its core. So all the payments we settle through the credit rails. And so we earn credit interchange on this. So we can afford to deliver credit card-like rewards, even on pay now, which is debit-like transactions, which is very unique as a value proposition for consumers, and really help sort of put more money in their pocket.
I mean, do you see, and so questions 2 and 3, right? Do you need the bank charter ultimately, and then also, ultimately, do you think the fintech competitive set starts to look a lot like you guys, right? Offering this, suite of products, enveloping the consumer in things that they need. I mean, what's the end state here, and how far away is that?
Yeah. So the question on whether fintech companies should become banks has been out for a while, and I think we're still a new industry. We're still getting data points on a regular basis, and I think over the last couple of months we got some useful reminders of what it is to be a bank.
What's happened in the last month or so?
And really the inherent risks of banks, right? And the inherent sort of mismatch between assets and liabilities. Banks really sort of funding originations with short-term liquid deposits, but then putting out of longer-term having longer-term and illiquid assets. And at most banks, I mean, you have a lot of people thinking about how to manage that sort of asset liability mismatch. And so what happened at SVB and First Republic is a useful reminder of really what it means and the risks inherent to that. And I think for fintech entrepreneurs, really a wake-up call of, hey, yes, if I was a bank today, the sort of FDIC could come in and seize the company, and my shareholders could be entirely wiped out. So the consequences of not managing this matching perfectly well are pretty dire.
I mean, you're leading directly into the next question, which I love. I mean, talk a little bit about this network of small banks. Who are they? Would we recognize any of their names? Where are they based? What are you seeing them since March? And my assumption is, look, they're probably even under greater pressure to raise deposits. The outflows they've seen to the big banks, to money market funds, all this dynamic, I think, has got to be even more accentuated. But what are you seeing from these 200 partners?
Yeah. So I think the way we've reconciled these sort of issues and like regulatory hurdles and sort of asset liability mismatch of running a bank on one side, but on the other side, the fact that deposits are a useful and capital efficient way to fund loans is we've created a network of about 200 banks and credit unions, like small community banks, small credit unions.
How long did this take to develop? I mean, it seems like kind of a genius move, but it probably took some time to get to that scale. No?
It took a good 5 to 6 years. And because it really works well if it's like well diversified, and if it doesn't work great if you have 5 or 10, right? You need to get into the hundreds. And each of them is pretty small, so you do really get to scale and have like billions of dollars of deposits and loans. You really need to sort of expand the network. And so instead of like trying to match assets and liabilities within our own balance sheet. We created this network of banks and credit unions where we have sort of bilateral agreements whereby we sort of raise deposits online on their behalf, and then sweep these deposits overnight to our bank and credit union partners. And then in turn, they use these deposits to buy loans from us. So we get that same benefit of sort of raising deposits and sort of funding loans, but instead of happening within a single balance sheet, and instead of us being the bank and taking all that sort of additional cost and loss of freedom to operate and capital requirements and so on attached to banks, we're able to sort of really outsource that function, also make it work a lot better, a lot more efficiently by sort of matching assets and liabilities at a network level across 200 different banks.
You guys pay a juicy rate. I thought it was closer to 4.5, but you raised it last night. It's close to 5, right? It's 4.8, something like that. So just looking at that, and then your loans, what you charge. I mean, your net interest margin, your NIM is going to be tighter than like Chase, for instance.
I think not necessarily, because we don't actually earn the NIM, right? The loans don't stay on our balance sheet. We operate as a marketplace. So for us, our fees sort of remain about the same. And if you look at the cost of capital for our bank partners, so the 481 sounds like a great rate on a savings account, but it's Fed funds minus 25 basis point, which is pretty much what it was. So on a relative basis, that cost of capital for our partners have remained about the same.
I mean, I guess looking from the perspective of the banks are still incented and motivated to be involved in this network. It's still economic for them to obviously be part of this clearly, right?
Right. It is, and I think the function we're really sort of performing for these like small banks and community banks is sort of really giving them access to sort of online deposit gathering, to sort of a national sort of base of depositors. I think it's been hard for smaller banks, for smaller credit unions to raise deposits on their own. It's become harder since SVB. And so instead of them like struggling to raise deposits from a small footprint, a small customer base locally, they can outsource that function to us, and we benefit from sort of our national brand, our ability to raise deposits online, and really funnel these deposits to the small banks that really need them.
Yeah, no, it's a cool business model. I think it feels like a win-win, so great. Renaud, we last talked I want to say in late September, and you said at the time, and this is so prescient, you were like, launching your high interest savings account, it launched at 3.5%, which I thought was like, all right, that's competitive at the time. You said to me, sometime in 23, you might see 4.5. And I think one of the quotes we had in the story at the time was just like, you're going to see the value of deposits. Deposits are going to be suddenly valuable again. And we've certainly seen that in March with the outflows being essentially death blows for some of these small banks, medium-sized banks. So I'm curious, in the months since, how has that savings account done in terms of, as a business for you, in terms of how much you pulled in, and then I have a follow-up question on that. But how's it done?
Yeah. So certainly deposits are valuable again, and I think it really plays to our benefit in launching that program of sort of loans for deposits with small banks and credit unions, because they really sort of need more deposit now. It's harder for them to obtain these deposits. It's become a lot more competitive, and we can flex rates up or down. I think the deposit gathering market, once you have scale and ability to access these resources online, is a very efficient market. So by dialing up or down of marketing and rates, we reach the right equilibrium and are able to really funnel these deposits to these small banks and credit unions that would have sort of harder time sort of getting them on their own.
And I'm going to ask you to put your prognosticator cap because you nailed it last time we spoke on this. But how high do you think rates are going to go in terms of what the consumer can enjoy? And then secondarily, what do you think that does in terms of pressure on the industry?
Yeah, so I mean, I don't know if I have a crystal ball, but I think just following the Fed's lead and sort of interpreting the language, I mean, it looks like we are sort of close to the sort of peak in terms of interest rates now. Obviously, we'll have to see what the economy, how the economy responds, how inflation fares in the next few months. I think the CPI reading from this morning was pretty helpful. So it looks like we're pretty much done. I don't think there's necessarily going to be a rate drop between now and the end of the year.
Right. Which is what the traders believe, I think, right? That there's going to be two cuts this year.
Right.
Yeah.
But I mean, I wouldn't be surprised if rates remain in that range of 5.25, maybe another 25 basis points, but like remain there for the remaining of this year.
Well, as a saver, I hope it's higher for longer. That'd be nice. So let's take a step back. I mean, fintech winter of sorts we're experiencing. The public companies still 50 to 75% below their all-time highs. Private companies as well. You've seen plenty of folks take, late stage growth, fintechs take haircuts. For me, a question I always think about is, are we going to see sort of a mass die-off here? And when could that happen in terms of, the fintech landscape?
Yeah, so I think we are going to see sort of either sort of failures or more likely M&A activity in terms of the fintechs. I mean, it takes a little bit of time for a bad economic environment or bad fundraising environment to work its way through the system,
Sure.
Especially after 2021, where a lot of fintech companies raised a lot of capital and they were still able to use that capital over the last 18 months. But I think we're getting to that point now where sort of it's been harder to raise capital or raise it at sort of a valuation that makes the shareholders reasonably happy. You also have like a few of these SPACs that sort of or hanging out there have raised capital at the time of the SPAC sort of merger, and now we'd have to sort of do something and at depressed valuations. So I think there is going to be more sort of M&A activity in the next 6 months.
And then, if we have time, I believe we've got time for one more question. If there's a big cane and they pull me off, that's why. So you guys, Upgrade hit a valuation of $6.3 billion, I want to say in late 2021. Is that valuation, have you grown into that in a sense? Because I know there's been plenty of growth since then, but late 21 was probably kind of timestamp the peak. And so, so in terms of your valuation, and then a quick follow-up.
I mean, it's an interesting thought exercise to wonder, like, if we were to raise money now, what the valuation would be.
Not that you have to. I mean, I think we've had that conversation too, that you don't really need to. You're profitable on a.
That's right. Yeah, we still have the money we raised at the time, and we've been profitable since. We are accruing cash every quarter. I mean, we've made a lot of progress since, but to your point, multiples have compressed quite a bit. So maybe we'd still be around the same valuation now.
And IPO window. I mean, that's another question. Is it going to reopen later this year, do you think? And you guys might take advantage of that, or you think 24 is more likely, or later than that?
I think in terms of the window in general, I wouldn't be surprised if you start seeing more fintech IPOs sort of early next year. I mean, even if the window reopens in the next few months, it probably takes like 3 to 6 months to just get going, and nobody's writing an S1 right now, so 6 month delay after that. It's probably Q1 next year. In terms of upgrade specifically, I think we're sort of patient. We're continuing to build the company, and we'll go public at the right time, but it's probably not next year.
Fair enough. If fintech IPOs have to wait until 24, I guess bad news for for bankers. They have to have a crappy year, I guess, for their bonuses, but that's fine. Look, appreciate your time. I always enjoy talking to you, Renaud, and we'll speak again, I'm sure. So thanks a lot.
Thank you.